In this video, I want to discuss the factors that make uranium an attractive proposition and why I believe that this is a great opportunity to look at Cameco. Many countries are aiming to reduce carbon emissions to zero by 2050. They are investing in renewable energy whilst ditching coal, gas, and nuclear energy. However, it's very unlikely that I will be able to produce all of our energy from intermittent sources such as wind and solar power. Unfortunately, when the wind doesn't blow and the weather gets cold, there's just not enough electricity generated from this source. In fact, because of this aggressive push towards renewable energy at the expense of conventional sources, Europe is now experiencing an energy crisis. Due to shortfalls in supply, electricity prices were up 6-7 times this year. So Europe has reverted to importing gas and oil again to generate electricity, and with the current high prices, this has caused its electricity price to spike. However, the world still needs to achieve net zero. Given that gas and oil produce CO2, it's hard to imagine achieving that target without clean power that can generate electricity 24/7. The only recourse is nuclear power. Nuclear not only purports to be a clean, safe, and reliable carbon-free solution, but it is getting cheaper as well. There are around 50 new nuclear power stations that are under construction now. Bill Gates and Warren Buffett are also investing in small module reactors, which are small-sized nuclear reactors that can generate electricity 24/7. Bill Gates advises that SMR will be cheaper and safer compared to the existing nuclear power stations. Whether they are in the form of SMR or large nuclear power stations, all nuclear reactors would need uranium. This means, theoretically, that the demand for uranium should increase significantly going forward due to the shift from conventional carbon sources to nuclear power. What about the cost of uranium? Let's look at the demand-supply curve in recent history and now. Uranium has, until recently, been locked in a bear market for a decade. Over the past 5 years, prices averaged around $25 per pound. What caused this bear market? You remember the tragic disaster at Japan's Fukushima Daiichi nuclear power plant on March 11, 2011. An earthquake off the coast of Japan created a tsunami nearly 50 feet high which engulfed the facility and left it without power. The cooling pumps became inoperable and the unthinkable happened. Reactors started melting down. In the wake of the disaster, Japan shut down all 54 of its nuclear reactors. Other countries around the world followed suit. It's a move that made sense. You see, anxiety regarding nuclear energy had already been building since the 1979 accident at 3 Mile Island in Pennsylvania and the Chernobyl nuclear plant disaster in the former Soviet Union in 1986. After Fukushima, Germany closed about half of its 17 reactors with plans to phase out the rest by next year. And around the world, countries started to phase out nuclear power and ban new construction. To showcase this worldwide trend, let's look at 2 top uranium producers. The first is state-owned national atomic company Kazatomprom in Kazakhstan, and the second is Cameco Corporation, a leading uranium supplier in Canada. Kazatomprom has been the world's largest producer of uranium since 2009. In 2020, it produced about 19,400 metric tons of uranium, which equates to about 41% of the world's production. In the aftermath of Fukushima in 2011, Kazatomprom cut its production by 15% from the previous year. In 2018, the company announced it was reducing production by 20% annually through 2021, and this past summer, Kazatomprom said it was extending the cuts through 2023. As other companies followed suit, global mining was reduced by 45 million pounds over the past 5 years. A similar pattern is seen with Cameco Corporation. In late 2017, Cameco announced it was shuttering its McArthur River or Key Lake mine. That immediately took 18 million pounds of annual production off the market. The company produced only 5 million pounds of uranium in 2020. That's a 44% drop from 2019's total of 9 million pounds. Yet it sold nearly 31 million pounds into the market. which translates to 7% of last year's global production. You might be wondering where the other 26 million pounds came from. That's because Cameco decided to purchase 33.5 million pounds of uranium last year. That's right. One of the world's largest uranium producers was buying uranium on the open market at spot price. You see, with prices hovering around $25, it made more sense for Cameco to meet its contractual obligations by paying market prices rather than producing its own at a loss. To make matters worse for uranium producers, nuclear power plants routinely stockpile several years' worth of this heavy metal. As reactors shut down, plants sold this excess inventory into the market, and with prices depressed for years, major manufacturers slashed production. The fact is, with inventories falling and production slashed, it was only a matter of time that the supply crunch would set in. It has taken a decade to work through it, but the uranium supply is finally depleting. At this point, you might be asking, with so much idle production on the sidelines, won't producers simply increase production to meet demand? You're right, but it's not that simple. The thing is, ramping up production takes time. It's not like flipping a switch. It's costly to reduce production, but it's also costly to increase it. Producers have calculated that the price of uranium will need to stabilize above $60 per pound before they are incentivized to increase production. And that's exactly what's been happening since mid-August 2021. The ultimate combination of falling production, exacerbated by COVID-19 lockdowns and rising demand for carbon-free uranium, has pushed the price to $47 to $50 per pound. So how has Cameco fared through all these twists and turns? Surprisingly well, all things considered. Despite a 10-year bear market in uranium and production of less than 10% of its total annual capacity, Cameco's financials are in good shape. It's a testament to a great organization and their astute money management. As of the 12-month period ending June 30, 2021, Cameco held nearly $1.2 billion in cash with just under $1 billion in debt. It generated $1.5 billion in revenue with $247 million in positive free cash flow. So the company is well positioned to return to full production capacity in the near future, given the uptrend in price. But, as I mentioned, it takes time to bring production back online. Even if prices stabilize at levels high enough to attract new production, it could take Cameco 12 to 24 months to get the McArthur River up and running again. But that doesn't matter. I don't need the company to increase its production to benefit from rising prices. Its assets alone will cause Cameco's share price to climb. Shares of Cameco rose to nearly $28.5 on August 11, 2021, its highest level since 2011. After profit-taking, the price fell back 20% to around $22 per share. I think that represents a good entry point for investors. With Cameco, I have the assurance that I am buying a blue-chip uranium producer with world-class assets in safe political jurisdictions. Despite years of depressed prices, the company has managed to keep its head well above the water. And I believe that I could see a dramatic spike in uranium prices over the medium term.